So, imagine this. It's 2026. The market's been on an absolute tear. But then, seemingly out of nowhere, it all goes into a freefall. Everyone's panicking, scrambling for answers. What is really going on here? Well, we're going to break it down. We're going to unpack the three big reasons that have come together to create this perfect storm for a market crash.
The scene is just pure chaos, You've got alerts going off on every screen, trading floors are a mess, and people's portfolios are just bleeding red ink. The whole feeling in the air has flipped from total euphoria to sheer panic, and it feels like it happened overnight.
And look, this isn't just some minor little correction. We're talking about the absolute giants. NVIDIA, Microsoft, the darlings of this whole AI boom, they are all tumbling. And it's not just stocks. Even things like Bitcoin, which had been soaring, are getting totally hammered. It's a massive, widespread sell-off, and it is happening fast.
But here's the thing. This isn't random. There are major hedge funds out there that are systematically dumping billions of dollars in stocks. So what do they know that the rest of us don't? Let's peel back the layers and really figure out what's driving this whole collapse.
Okay, so our first major clue. It lies with the biggest players in the game, big tech. See, they've made this enormous, incredible bet on the future, but it's a bet that's making investors right now very, very nervous.
Guests get a load of this number, $700 billion. That is the combined amount of money that giants like Amazon, Google, and Meta have announced they are pouring into artificial intelligence. Now, on the surface, that sounds like a good thing, right? I mean, who doesn't love investing in the future? Well, not so fast.
To really get why that huge number is actually a problem, we need to talk about something called free cash flow. Now, put simply, this is just the cash a company has left over after it's paid for everything, all its operating expenses. For investors, this is the number that really matters, because it's the money that could, potentially end up in their pockets.
So, a company basically has two main choices for what to do with all that free cash flow. They can give it back to investors, either through dividends, which is a direct payment, or by buying back their own stock, which drives the share price up. Or they can reinvest it back into the business, for example, by spending a ton of money on new AI infrastructure.
And this, right here, this is the heart of the problem. Investors are looking at that $700 billion, and they don't see some bright, shiny future of innovation. No, they see cash that was supposed to be theirs getting siphoned away into these massive, long-term projects with absolutely no guarantee of a quick payoff. And when that immediate return on their money just vanishes, well, they start selling.
Okay, let's move on to our second factor, because this tech sell-off isn't just happening in a bubble. The entire economy is starting to flash some pretty serious warning signs. And believe me, that changes the whole calculation.
To see what I mean, just look at the job market. Back in January 2023, the U.S. economy added a whopping 500,000 jobs. Pretty great. Now you fast forward to January 2026, and that number is projected to be just 20,000. That is a staggering slowdown, and it's a classic flashing red light for a potential recession.
So what even is a recession anyway? Well, the simple version is it's just a period where the whole economy is shrinking instead of growing. Economic activity just slows down basically everywhere you look.
And the path to get there is a pretty clear chain reaction. It's like dominoes. Fewer jobs means people have less income. Less income, well, that means less spending. And when consumers and businesses spend less, the entire economy slows down. And that leads to negative GDP growth and, boom, recession.
Now, here's why that's so important for stocks. When it feels like a recession is just around the corner, a dollar in your hand today is worth way more than the promise of a dollar tomorrow. The risk that those future profits might never even show up goes way, way up. So what do investors do? They sell off stocks that are all about future growth, like tech, and they rush into assets that are generating cold, hard cash right now.
And that brings us to our third and final driver of this whole mess. Complete and utter confusion coming from the one place that's supposed to provide stability, the U.S. Federal Reserve.
The key policy you need to know about here is called quantitative easing, or QE for short. Basically, it's the Fed creating new money to buy government bonds. This pumps a ton of cash into the financial system, and historically, it's been like rocket fuel for stock prices. The opposite, by the way, is called quantitative tightening, or QT, which takes money out. Okay, now just look at this policy whiplash. It's crazy. The Fed was in tightening mode, taking money out of the economy. Then, at the end of 2025, they do a complete 180 and announce they're going to start easing again, pumping money in. But now, there's chatter that a new Fed chair could get appointed who is famously against QE and might just reverse the policy all over again.
And this all boils down to one simple, timeless truth. If there is one thing the market hates more than bad news, it is uncertainty. And with no one really sure which direction the Fed is actually headed, investors are just defaulting to the safest possible move: sell first and ask questions later.
So now, let's put all the pieces together. These three forces, they aren't acting in isolation, not at all. They are feeding into and amplifying each other to create the perfect storm that is absolutely hammering the market right now.
And why is this storm so incredibly powerful? Well, because the top 10 tech companies, they make up a full third of the entire S&P 500 index. So when these few giants get slammed by all the factors we just talked about, they don't just fall on their own. They drag the entire market down with them.
So just to recap the toxic combo here, you've got big tech making investors mad by picking massive spending projects over profits. You've got a slowing economy that makes those future bets look even more risky. And then you have the Fed just layering a huge blanket of uncertainty on top of everything. It's the combination of all three that creates the crash.
And that leaves all of us with the really big question: is this crash just the market blowing off some steam after an incredible run, a painful but maybe necessary correction, or are these underlying problems, the spending, the economic fears, the policy mess, a sign of a much deeper, much more serious problem? That is what everyone is now desperately trying to figure out.